Hello and welcome to the Mutual Fund Show. And at the onset of the show, Sal Mubarak to all the viewers. May it be a really good new Samvat for you. We'll kind of do this all through this week simply because it's Diwali time. But at the onset of the Mutual Fund Show, the first Mutual Fund Show in the new Samvat, we thought it's pertinent to talk about something that might be a pressing issue for a bunch of investors who have chosen to diversify their portfolios away from being only India-centric to also being global-centric. Now, mind you, it's a good strategy. In most cases, it turns out to be a really good strategy to diversify because it's a better risk-adjusted return that you're setting yourself up for. The only point is, in the recent times, India has tended to do really well. A lot of other global markets may not be doing all that well. So therefore, it's pertinent to take stock of the situation now to try and understand whether it's good to stick with an old strategy or is there a way to devise a new strategy, what to do with some of the funds which have got these global exposures, or are global funds in the true sense. To talk about that, two experts who joined us often on the Mutual Fund Show, and we love having them again, Prableen, Bajpai, and Vishal, Dhawan. Both of you, thank you so much for joining in, and a happy new year to both of you.
Thank you. It's a pleasure being here.
Thank you so much.
Yeah, thank you. Thank you, both of you. Prableen, can I start with you? An investor is looking at her portfolio or his portfolio in the last 6 months, 9 months, and thinking that, hey, did I make a mistake by diversifying or diversifying at the wrong time simply because the India-centric funds are doing much better than what the globally diversified funds at large could be doing?
Yeah, Neeraj, I think it is definitely a time when a lot of investors with global allocations are probably wondering whether it was the right call to make to diversify outside India. But I think at the same time, it's very important to look at some of the reasons why, especially the US markets, probably aren't doing well the way they should have been. Although different movements at different points in time is actually the reason or the core of diversification. You invest into other markets, other geographies, economies, only because you know that probably all of them are not going to grow at the same pace or have the same sort of return trajectory. So let's start with US. So I think US-centric funds, we saw the pandemic. It was a bad time, 2020, for the Indian markets and the US markets. And then the Indian and the US markets, everybody rebounded. The US economy also rebounded, but that was back on the back of a very strong fiscal stimulus, which those markets were getting. And that stimulus, I think the Federal Reserve this year, sometime in July, actually accepted that, they saw a huge increase in the consumption across sectors, but there wasn't really much a difference in the production that was taking place, and there has been a lot of price tensions which happened because of that. And according to their own report, there has been a 2.5% inflationary impact only because of the fiscal stimulus that Fed has pumped into the US economy. And I think the timing has been such that Feb of this year, again, Ukraine and Russia war that started. And all of this together with the Federal Reserve's policy stance of monetary tightening has definitely engulfed the US economy into a time where they are seeing a drop in consumption demand, which is the main stimulus to their economy, which is a huge part of their GDP. And this is further, sort of putting pressure on spending, especially real estate. We've seen some figures come out yesterday, day before. So we have a very subdued sort of a projection for the US economy for this year. It's about, I think, a 1.6% for this year and about 1% next year that we are seeing. So overall, because a lot of growth stocks and tech stocks are part of the US exchange, which are the biggest stocks in terms of market capitalization. And these are the sectors which are hugely impacted by any sort of interest rate movements because the cash flows, are discounted at higher rates. And that's why we are seeing the bloodbath in the US economy. And also that some of the important sectors, technology and healthcare, Neeraj, which are a huge component of their indices, saw too much of a run during the COVID times because these two sectors actually performed. And now, if we see year to date, it is only energy which is up in the US. Even in the last 1 year, data suggests that the energy, that sector is up by about 52%, and all other sectors are currently in red. So it is a difficult time, but investing in outside India, just like Indian equities, is for the long term. So I think we need investors need to stay put and not sort of exit in haste.
Not exit. Okay. Vishal, would your thesis be similar? That is part one. Part two, what what should an investor tell herself right now when faced with an option of either continuing the SIP or versus pausing it, swapping the funds that might be there into funds which might have better near-term strength as compared to global markets might, if you will, and especially people who have invested in some funds which invested in those FANG stocks, for example, right? Because yesterday's results from some of the big tech companies have brought down these even further. So how does an investor approach this?
So I think there's 2-3 different angles to this that are very important. One is clearly, this sort of story of performance or performance of India versus the rest of the world. Very clearly what's happened in the last 12 months, and since we are talking, Samvat, it's good to talk Samvat to Samvat. You will really see that the Nifty, for example, is down roughly about 2% in this period of time. Global markets, if you use the S&P 500, for example, as a good benchmark, are down maybe about 22-23%. But you need to add the dollar strength on top of it, and then you'll suddenly see that if you look at it on a rupee basis, the difference is not as significant as it appears to be. Of course, global markets have underperformed, but the difference reduces because the rupee has also lost about 11% against the dollar in the same time frame. So I think one of the big reasons why investors also need to diversify overseas is to manage currency better. And what has happened in the last 12 months is the asset class impact of underperformance on equity has been larger than the impact that has come up on the currency side. And therefore, we are saying that, when you look at your numbers, just look at them in the same currency always. Don't look at one number in one currency and one number in the other currency, because it may end up enabling you to take wrong decisions just because you're looking at just the absolute number in the local currency. Besides that, I think the important element is if you go back in history and look at data, it's very, very common to see one geography outperform another year on year. And in fact, it actually feels a bit like you being able to predict the future, because if you pick the best performing market in a particular year, it's very likely that that's going to be amongst the worst performing markets in subsequent years, and vice versa. And while no one knows whether that will happen next year or not, I think probabilities are always in that favor, that you don't want to chase the winners of the last year, because that normally tends to be a bad strategy. For a lot of equity investors, I think they really spend a lot of time looking at valuations. And I think if you look at global valuations versus India valuations, you can clearly see that a very large number of global markets now are either in line with long-term averages or actually at a discount. Whereas if you look at India, India is clearly at a big premium to its long-term averages. And therefore, you also want to keep in mind that you might be buying a more expensive geography if you now start to think about tilting your portfolio towards India. And you may end up, therefore, repeating a mistake that may have happened earlier, where you may have chased the higher return from a particular international geography and then found that valuations have actually normalized. So I would say that it's very, very important for you, just like you have a asset allocation amongst equity, debt, gold, etc. You also have a clear idea in terms of what is going to be my mix of domestic versus international equities in my portfolio. If, let's say, you've decided that that mix is going to be 80-20, and that mix is now shifted towards being, say, 65-35, because equity markets internationally have corrected much more, then you want to go back and rebalance, which means that you want to actually buy more international equities by selling down Indian equities and not vice versa. So clearly, if you're running an SIP, you might want to redirect that SIP towards international so that you can minimize your taxes and still achieve the same objective.
Here's the question, Vishal. Sorry, my follow-up. Here's the question, right? There is, and I think Prableen has a view there too, and I'll get to her in just a moment. But let's say there are some funds which invest in China, right? Now, all across, we hear articles of how slow the Chinese economy might grow. So my question is, if I have a fund which is investing in an economy which is not likely to grow as fast, why should I, for the sake of diversification, invest in that fund? Why not take it off, either invest in another global fund or just invest in India? Because India versus the USD, yes, the rupee is depreciated. The rupee versus a bunch of other currencies, the rupee is not depreciated as much.
Right. So I think it's again important to look at China from the perspective and the lens that, how do valuations in China actually look like? So there is a clear, GDP slowdown that is being talked about. Of course, this quarter's numbers were actually a little above what people expected at 3.9%. But maybe, as time passes, a lot of the zero COVID strategy will start to play out with maybe more damage. But I think the important element here is how much of that slowdown is priced into equities already. Because, all of us know that equities are a very forward-looking asset class. And therefore, a lot of the news gets priced in very, very quickly in terms of, both good and bad. And therefore, our belief is that while you might decide to go a little slower on China as a result of maybe some of the news that is emerging around, how the new Chinese structure is going to be, how maybe, growth is going to be slowing down, etc. I think you also don't want to end up in a situation where you have the second largest economy in the world, not a part of your portfolio at all. Because at the end of the day, you still have a very large domestic consumption story in China, which is very, very dependent on, which is completely dependent on the local Chinese consumer, who's actually very wealthy. So we would say that if you're a little negative towards China, you might want to reduce your exposure. But it's unlikely that you will want to make it zero, just because there is so much of news flow which is currently negative around that particular geography.
Probably just before we get into specific funds, the same question to you really very quickly. And your view can be different from Vishal's, right? I mean, what does an investor who's got multiple exposure to multiple funds via multiple geographies do? Is the swap warranted?
So I think, Neeraj, when it comes to international investing, I have spoken about this earlier, that I think US or the developed world should be the first choice. And I think exposure to China or the greater China region, I think comes at the second level. So it's for the more savvy investors, it's not for the first time investors. That's what I feel. Having said that, there is potential in those markets, just like Vishal has mentioned. It's a contributor of 16% to the global GDP. It is, in terms of its economic strength, it is a strong economy. I think you only tweeted some time back, India's imports from China have actually risen. And China, I think, is working at sort of restructuring its own economy, because I think it also understands with the China Plus narrative going around, they have had trouble in their own real estate sector. So I think the government in China is also looking to revamp its own economy. They are giving stimulus in terms of monetary and fiscal packages. They have the potential, because unlike all other geographies as of now, they don't have the problem of inflation. Having said that, China brings with it certain sort of regulatory risks, political risks, and of course, economic risks. So I think the regulatory and the political risks are not really present in terms of economies like the US. I think they're more transparent, easy to understand. So for the second level investors, more savvy investors, China can be a good area to invest in. But I think not at all for the first time investors. And those who have already invested, again, I think now is the time when they are actually looking to invest and rebuild their economy, because, in terms of electric vehicles, you see in terms of mega solar wind projects, you see in terms of the, all the regulatory hassles, most of it is over. They have, fined and taxed a lot of their own companies and now allowed newer registrations, and things are getting slightly back on track. But of course, the Taiwan-China issue again came up. So I think stay put for those who've already invested, but it is, I would say, a no for a retail investor who doesn't have exposure to other geographies.
Got it. Okay. So let me try and you guys can elicit the names, but let me just try and figure out specific pockets, right? And then we can wrap up. So what to do? Probably to you first. What to do with funds which have exposure to part India and part global equities? So there is a PPFS which does that. I think there's a DSP fund which does that, and a couple of others. With those funds, what should the strategy be, if you have a view?
So for those, we have a lot of funds actually, Neeraj. We have the PGIM Global Equity Opportunities is there, DSP fund is there, where you have exposure to Europe also, partly China as well, US. So it's a mix of different geographies. So I think in times of chaos, it is also an opportunity for those who do not want to add on new funds or are not, comfortable taking the exposure. It's okay to stay away from those. But I think for those who have already invested, maybe incremental exposure can be taken only if they have a long-term view. We of course know that Europe is not in a good situation. We know that there is weakness in the US, there is crisis in China, but at the end of the day, Neeraj, I think we are in a globalized world. So India cannot also grow in isolation. We are much stronger. We have better macros. We are way better in if we filter and we see the data. But we are part of the global setup, and I feel some exposure outside can also insulate if things don't go that well. In India also, we'll have elections in 2024. There might be some other issues. I think we still have people who would want to send their children abroad. We are still buying iPhones. So if you look at your own personal life and consumption and your life change, decisions, how much is actually this going to impact the current situation? That means that we are consumers of products outside. We are still going to visit these geographies. So from that point of view, I think it's a tough time, but the better way is to either add incrementally or stay put and do nothing as of now.
Okay, let's stick to the larger bucket first and then come to individuals. So Vishal, the HDFC Developed World Indices Fund of Funds. So I mean, can you share your thoughts on this one? Because I think you want to talk specifically about that as well.
Yeah, so I think very clearly, two things are happening. One is there has been this event that happened at the start of 2022 around, how international funds can actually take money in. And that may have actually worked well for some of these hybrid sort of funds, which had a combination of domestic and international. Because even though they may not have wanted it, the international exposure has petered down by default because they haven't actually had an ability to add more. Now, this could actually be bad news in the long term, but at least in the short term, it has probably helped the fund. So you were talking about something like a Parag Parikh, for example, where the allocations have gone down from 30% to 18%, just because there are no fresh allocations happening. As far as the HDFC Developed, index fund is concerned, very clearly the biggest advantage that it gives you is access to the equivalent of the MSCI World. And the way we look at it is that, most of the geographies in there, 70% of that exposure is actually the US. About 14% is Europe, 6% is Japan, and the rest of the 10% is across other developed geographies. Most of that money actually, therefore, ends up going to the US, which is corrected quite sharply. In fact, if you look at some of the big tech names that you were referring to, a lot of those make up the top 5 names in those portfolios, and they're roughly about 15% of the portfolio. So we think it's a good idea because you do see that the correlations over long periods of time between the Nifty 50 and the MSCI World are roughly about 0.4, which is a good, very, very good diversification tool, even though in the short term, when you look at the same correlation numbers, they are in closer to between 0.65 to 0.7. You get access to all of this, of course, at a low cost because these are index products. So expenses are only 21 basis points. Fund sizes are decent. Very interestingly, if you look at long-term data, you will actually find that the MSCI World has outperformed the Nifty 50 in dollar terms with a much smaller standard deviation as well. So it's fairly interesting that the short term could look very different from how the long term looks. And therefore, our suggestion is that you go ahead and continue with adding money in, use SIPs, STPs, gradual investing strategies, so you can deal with some of this macro uncertainty that everyone is so concerned about. But we've always found that, while macro is important, it shouldn't end up becoming the only thing that drives portfolio construction. And portfolio weightages are also very, very important when you're constructing these.
Yeah, fair point, Vishal. Thanks for that. Prableen, couple of nailing it down even further to a couple of geographical funds, right? I mean, the Nasdaq 100 and a bunch of Indians would be invested in directly in these Nasdaq listed stocks, or for that matter, these kind of funds as well. And that's seen a severe drawdown, and it continues as we speak. What to do there?
So I think we just had a NFO by Axis for Nasdaq 100, and I think overall have about 7 to 8 funds which are providing exposure to this index. So it is one of the best large cap indices in the US, Neeraj, and it's a very good passive strategy to take exposure to the largest economy. And it's one index which really provides exposure to all sort of innovation which is taking place, whether it is cloud computing, Zoom, it is cybersecurity, robotics. Certain sectors like cybersecurity, they are currently at about 180 billion, are projected to be to the size of about 450 billion in the next 7 to 8 years. Robotics is there, cloud computing, which is about 480 billion, is going to be about 1.5 trillion in the next 10 years. So there is potential there, but the negative impact of the interest rate movement is definitely hammering a lot of technology stocks. And second, they have healthcare and biotech as the second largest. That's also a huge component in the index. The second largest, but a huge component. And again, after COVID, that sector also has seen sort of a lull. And overall, I feel that this is one of the good indices where investors should, who are investing outside India and are looking to invest in US, can take exposure. Also, JP Morgan report has certain 5-year projections. So according to them, IT will be the top performer in the next 5 years again, followed by consumer discretionary. So I think it's these are sectors and stocks where definitely a lot of hard times currently, but I think long-term view, my personal view is positive.
So continue
with your SIPs for sure.
Got it. Okay. Well, I think we have run the course of time on this show, but I think we've discussed most of the points: the China fund, the Nasdaq, and the overall umbrella funds. So on that note, Vishal, Prableen, both of you, thank you so much for taking the time out and being with us today. Really appreciate your time.
Thank you so much.
Always a pleasure.
Yep. And viewers, thanks for tuning into this leg of the Mutual Fund Show.